Is it too late to sell? Is it too late to sell? That's going to be the theme today because I've seen all of these. Now, if you've been listening to us and following Revere, you've sold quite a long time ago. You've been holding lots of cash. But I see all these articles now coming out talking about, should you poll your clients? How should you reach out to your clients and tell them? See, most clients have lost 25%, even if they have bond portfolios. Bonds are getting incinerated as well. Nothing is working in stocks and bond world. And so I'm seeing all these articles come across. In fact, an article came across saying Goldman Sachs slashes equities to underweight and Blackrock says shun most stocks. Thank you very much for that heads up in advance. Looking in the rearview mirror in hindsight.
They're like meteorologists.
You know, I already have my pie chart of 75 cents on the dollar, and now they're saying, by the way, you may want to avoid these things. Okay, how about a little bit of a earlier indicator, right? And then there's also a very good. Now this I can't really post this as the links on in the show links, because it's actually an institutional. The guy sends it in a PDF, but it's an economic outlook and format, and it's on the dollar. Oh, and it's on the Fed and the dollar. You may be able to Google it and find it. It actually is called Macro Strategies, and it's by Andrew Lees, Lees, and it says, "Where's the bid? Where's the bid?" And it's talking about how the strengthening dollar is causing havoc both in the global markets, but here at home too. And there's a liquidity crunch. It's creating a liquidity crunch, and it gets pretty heady. It's a little bit too deep in economics for the layman. It's kind of tough to understand. But the main point is everybody always talks about the inverted yield curve, which, by the way, we're inverted right now. And it talks about how that's such a good indicator for recessions. And in the last 7 out of 10 inversions, we had 7 recessions out of the last 10 inversions, right? But 3 of them, it didn't cause a recession. We came out of it without going into recession. Now, I'm not counting this one. We're actually in a recession, according to the classical definition. Yes. But the government politicians say, no, we're not yet. I don't know what they're smoking, but it's, I don't have it in my house. In any event, this guy's talking about, but all 7 times that happened, there was a liquidity crisis. So the 3 times that we didn't go into recession when the yield curve inverted, there was no liquidity crunch. And so right now we're starting to get a liquidity crunch, folks. You need to pay attention. But this is, can they see this, man? This is the macro strategy. This is the guy right here. If you can find that online somewhere, Andrew Lees. It actually is a great read. It's for, I'm just not supposed to pass it out. It's not for, it's for institutional consumption only. Please don't forward this. You got to pay for it and all that kind of stuff. Yeah. But you might be able to find it. And then lastly, the SEC has decided it will not ban order flow. If you've been listening to the show about a few months ago, they were talking about the order flow and how it's kind of, there could be some ethical issues with it, and you're not getting best execution, and how do you protect the client? And I said at the beginning that the regulators, they were influenced by the big brokerage firms and the insurance companies that have already set this model in place, and they jawbone about it, but they wouldn't, at the end of the day, they wouldn't do anything about it. And we got confirmation they're not doing anything about it. So in any event, all of these links, so the last one is, which is, it corresponds to what this guy's talking about, Andrew Lees, is another article on Advisorpedia, and it says, is the Fed trapped with debt and liquidity? The answer is yes. I'll give you the Cliff Notes version. Yes, because see, compounding works both ways. So it's good when it's going up, but when you suck the money out and you raise interest rates, and it actually causes things to accelerate downward. So it compounds downward, which is what we're seeing right now. Anyway, if you want to read any of that stuff or that economic stuff, all the links are posted on the website, and we can go into that. We can have a discussion, but really, most people, they start nodding off and it puts them to sleep. But if you want to talk about that, certainly reach out to me. You can call me at 855 Real Wealth or just email me, dan@revereasset.com, and I'll be happy to dive as deep, or is it as deeply as you would like? Is it deep or deeply, Don? As deeply as you would like?
I would go with deeply, and I would caution anybody not to go too deeply.
Because see, what Don is saying is, I speak Don. Mm-hmm. It's price is truth. None of that matters. Follow the charts.
Right.
That's the anyway. All right, folks. Before we get started, though, we have to give the disclaimer.
Of course,
this is for your research and entertainment. It is not meant to be individual investment advice. If you would like, need, or seek individual investment advice, reach out to me, the better looking one, or Don, either one of us, or you,
the more humble one.
Or you can just go to revereasset.com. All of our stuff is there. Or you can reach your own independent advisor, and hopefully they're not in a pie chart and down 25% for the year. Okay? All right. With that said, I think, guys, if you guys want to talk about any of those topics, I'd be more than, and one last thing, we are going to go to Michael talking about a specific sector that he wants to go over. But before we do, guys, do you guys want to talk about any of those topics, or should we just get right to the markets? Because I think it's pretty dangerous right now. I still think it is. And I still hear people now kind of coming back saying, well, I've lost this much money now. Now, how do I can't sell now. It's probably near the bottom. And I'm thinking, you don't know that. It could easily go down another 20%. Right. And right now, the markets are not looking really very healthy. So I'm going to flip it over to Don, and Don, do you want to talk about the Fed and some economic policies, or do you want to just get straight into the markets?
Well, yeah, the Fed and economic policy, I'll pass on that.
Is there anything else you want to talk about besides the market?
What do you think, Dan?
I knew it.
You did say you speak Don.
Well, and listen, folks, normally on most shows, we actually go over a few topical things and have a little fun and cut up and talk about some important economic or political things that will affect your investments, and that's all good and well. But right now, it's too important not to talk about the markets, because people need to figure out what they need to do if they haven't already taken decisive defensive action. So with that, Don, I'm going to turn it over to you, and why don't you kind of talk about the state of the markets? And by the way, hats off, kudos on that very short-term trade. You were kind of hoping it'd last maybe a little bit longer, but we actually came out unscathed with a slight profit. We'll talk about that a little later. But Don, go ahead.
And the feedback from that trade actually told me all that I needed to know about the market. So obviously, if you've been anybody that's been watching this knows how defensive we've been. All three time frames and leaders were on bearish / downtrend signals. We came into the week in cash. We're below all the moving averages. Leaders broke down last week. But
the markets are below.
The markets broke. I got to stop doing that. Because we're all in this together, right? No, we're not. The markets are what is extremely risky. At Revere, let me just summarize it this way. Revere, we're down 7.7% year to date. The market, the S&P 500 as of right now, is down 23.7%. So we've done a good job at Revere getting out of the way. And with the undercut of the lows, the prior low being this 36.87, we undercut that today, which means this is officially a third leg down. How much lower it goes, we don't know. But you can see this was the first leg, basically from January to mid-March. Then we had a bounce. Then the second leg was the top of late March to middle of June. Then we had a really strong bounce up into the 200-day moving average, and now we're in the third leg down since that pullback from 43.25. So yesterday in the video, I commented that anybody that we've talked about ATR for a while on here. Offensive selling and defensive selling can take place when your 3 ATR extended either to the upside or the downside. Sorry, I should have said offensive selling or defensive buying. When your 3 ATR extended from the 21-day exponential moving average, and we hit that yesterday, the ATR on the S&P 500 is a little over 2% right now. We closed yesterday at 6.3% below the 200-day. So it puts you in the prime spot for a regression back to the upside. Now, I wasn't expecting to sit in this all the way back up to the 21. I was thinking maybe we would get to the 80 MA. We had a gap up this morning, overnight strength, but we topped within 12 minutes of the market opening this morning. If you take a look at a 5-minute chart here, you can see the gap up to 37.17. And then we just started making lower lows and lower highs. We had one H pattern confirmed to the downside, then a second H pattern. The market's worse than I was even thinking that it would be. When you can't get a bounce when your 3 ATR extended from the 21-day exponential moving average, that means that all bounces are being sold with two hands by people trying to get out of the market. We're not fear mongers here. It's all backed by data. Nobody likes to participate in an uptrend any more than we do at Revere. We had a fantastic year, up over 45% in 2021. Gave back some of that in 2022 when there was we're a growth stock shop, and growth stocks underperform. So anybody that is in growth stocks was swimming upstream in 2022. But look at these numbers when you get into bear market territory and how long it takes to get back to it, especially if you get into the severe bear market mode. We haven't seen any indications that the economy or the market is anywhere near a bottom. In fact, just the opposite. You had Powell come out on 8/26 from Jackson Hole and say, after the market was having this nice bounce up, say, you're not listening to me, market. We're going to raise rates until inflation gets to 2%, and we're not going to cut rates, because the problem they made back in the 70s and the 80s was as soon as it looked like inflation was slowing down, they cut rates immediately and inflation picked right back up. So he's saying not only are we cutting, not only are we raising, but we're going to pause them. We're not going to cut and make sure that inflation is in fact under control. So the market sold off on that, had a little bit of a bounce, and then the CPI data came out on 9/13, and this is really what's been responsible for this latest leg down. Pre-market on 9/13, we were gapping up. The CPI data came out, and the market just sold off hard and has been kind of in a waterfall-ish situation since then. Same situation that happened back here at the beginning of June. When we were waiting for CPI, it came out, we gapped down, and then we gapped down again on Monday around this June 10, June 13 area. And now we made lower lows today, even though we're still extended from the 21 exponential moving average, 6.3% for the second day in a row. At some point, when you get extended to the downside, this is also the 6th day down, the first time we've had 6 down days during this entire bear run. But we went over at pre-market with Michael and Ted. The most we could find is 5 on the S&P, 6. You could have 6 if you went by the futures, but we key off the S&P here. This is the day 6 down. We undercut the lows. The low so far is 36.26. We bounced 11 points off of there back to 36.37. So it's possible this is an undercut and reclaim of this 36.37. We'll have to see how we close, but the weakness and how immediately we sold this morning after opening up higher gave me the feedback that this market is even weaker than I was giving it credit for.
Yeah, well, no, absolutely. And I'm going to put my Don interpreter on a little bit for the people that don't quite get all the technical jargon. So when he's talking about ATR, that means average true range. And so he's looking at the range of the stock, and one average true range is kind of within the norm. When you get out 2 times the average true range, that's a little bit out of bounds. That's a little bit abnormal. When you get 3 ATRs out of the normal range, it's almost like a standard deviation. It's just a big outsized move. And so when it got 3 ATRs to the downside yesterday, and the fact that we had 6 down days in a row, Don was thinking, okay, we're primed for a bounce. It's probably going, the market appears like it wants to bounce. And so he took a triple long on the S&P yesterday right before the close. Now, with that in mind, it was a 5% position. So it really is only 15% net exposure because our portfolio is 100% cash. So we're totally in cash. And this morning when we got a pop, he took profits on half of it and watched the other half, hoping that it would continue to run, and the market rolled over. And the second half was about like a couple penny loss, but the net effect is both positions combined was a small gain. But we're not really well. I don't want to say we're not concerned about a gain or loss. That position in and of itself is not the main takeaway here. The thing is, Don put out a little feeler and took a little bit of exposure to see if we could get a bear market rally, essentially is what it is. And that bear market rally lasted 15 minutes, and that's not a good sign for the markets. And that's what he meant when he said the markets are weaker than even I thought. Okay, and that's why we don't think. That's why we follow the rules. Now, right now, the Dow futures are down 220 points, 0.75%, and the other indices are down just slightly, a little bit less. But the whole point is, it's very dangerous, and you don't know how low can go. Bottom fishing, or quote, buying the dip, is very dangerous in this market. So my vote is no, it's not too late to sell if you haven't already. Don, what do you say? Do you think it's too late to sell? If you have someone that comes to you and says, here's my 100% long pie chart, what do you do? How do you handle that?
I review the individual positions, and knowing that we're extended to the downside, I would hedge. And if we start to bounce, I would take the hedge off, see how high we get, and then start taking the individual positions off. I would get to neutral, but not necessarily by selling everything.
Right. So I see Don do this every day. So let me kind of elaborate on what he's just said. So when he comes, say we get 40 stock, and by the way, we see this all the time. A client will come in with 60 stocks at a little under 2% each. Well, if you're doing that, you're really tracking the index. You might as well buy an S&P fund. But Don immediately goes in there and looks at every stock and goes, dog, 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 sell, sell, sell. These are actually holding up pretty well. Here is my underneath, my sell stop underneath, and here's my alert. We don't use hard stops, but he uses alerts both to the upside and the downside. And then if we got anything we're buying that's still within buy range that we own already, which we don't own anything now, but if we own something, he would buy those few things. And so we don't just sell willy-nilly and just buy all of our stuff. We homogenize them in very judiciously. See, in the traditional advisor brotherhood, it's not about the investment business. It's about the changing of the investment business. So if you don't buy all their stuff, a lot of times they don't get paid on it. So when you first transfer in, they clear out every single thing you got, and then they go buy everything that they own, normally in mutual funds. But here's the thing. If you have told your advisor that you were nervous and scared 15% higher ago, and he said, no, just stay the course, it's going to be fine. The market always comes back, which is true, especially if you've got the longevity of an oak tree. But when you've got the lifespan of a human, the question is, will it come back in time when you need the money? Okay. But if you're calling him and saying, man, I'm really scared now. No, you know. Now, granted, it is a lot easier when you sell early on, when your first levels break. Usually your first sell sign is your best sell sign, your first signal, rather than waiting for 2 or 3. What a lot of guys do, a lot of traders do, is they start breaking their own rules. They'll hit the first signal and they'll go, well, I'm just going to move my stop loss down a little bit, or I'm going to give it a couple more days. I'm going to give it a little bit more time. And before you know it, you're down another 10% and Bob's your uncle. And you've broken your rules. And that's why even if you have 10 guys just like Don or Michael or Ted, right? if only 2 or 3 of them are going to be any good because the other 7 get emotionally attached and they break the rules. And so that's why it's so important. But folks, if your portfolio is bleeding in the streets, at the very least, you can take some action and you can do some hedging. You don't necessarily have to sell everything willy-nilly, but you definitely want to look through your portfolio, and you need to prune the ones that are weak and then go and maybe do some kind of hedging or some kind of strategy for the ones that are strong or stronger. But just sitting there and hoping is not a plan. Hoping when the market comes back is not a plan. You need to ask your advisor, what is your sell discipline and what is your buy discipline? What are your rules? Do you have investing rules, and may I see them? If he doesn't or can't, or she, and can't elaborate or articulate them, I've got 1 3-letter word: run. Okay? After you sign the transfer form and go somewhere else. Anyway, and by the way, guys, and I told Don, because I thought of this when I was traveling last week, and thank you for covering, Don. I asked him, I texted this quote: "It's not enough to be a fiduciary. You've got to be a fiduciary with a sell discipline." Okay, we actually got a couple clients just yesterday, 2 in one day, that came. I'm not going to say his name. Came from another advisor that has all these commercials on CNBC and radio and everywhere about how they're your fiduciary, how they are your fiduciary. But you know what they do? They buy 2% of 50 different stocks and act like, because you have individual stocks, it's sexy. It's not a mutual fund. But then they buy it, they set it, and forget it. And these people are down 26% year to date. And they finally hit their pain threshold, and they called Revere. So in any event, I've beaten that pretty good. I just want to make the point, because people now are, look, humans by our emotions, we either got fight or flight, okay? Most people flight, they run. Only a few people run toward the gunfire, right? There are a few people built like that, and that's fine. We need Marines, right? You need to have soldiers. But in this thing, it doesn't help. You've got to have rules, and you got to know what you're going to do. But people freeze. They will freeze, and they won't do anything. And so now they're frozen because they don't know what to do, and so they just kind of shut their eyes, and they hope for the best. Folks, that is not a plan. You've got to do something, and if it's not with us, someone else, that's fine. You just need to figure out something you need to do, but you need to find someone that actually understands markets, and it's not just a salesman. It's not just an asset gatherer that is on your side and that has a sell discipline. All right. I think we've made our point. Let's go to Michael. Michael, you've got a sector that you want to talk about. You've got this managed healthcare, managed services, and what do you want to let the listener know about that?
Yeah, so last thing, I just want to mention something about what we were just talking about. Jeffrey Gundlach, for those viewers that don't know him, he's considered to be the bond king. He's got a fund called Double Line Capital, and they run billions of dollars. He's the bond expert. And even Gundlach last night tweeted saying, "The U.S. Treasury bond market is rallying tonight. It's been a long time. I've been a buyer recently." Well, if you look at those treasuries, the 10-year yield is up 2.5%. The 30-year is up over 3%. So he's already down 3% on his position. So even or probably more if he's been a buyer recently. So even the experts who manage billions of dollars, trying to fight a trend or headwinds, like even they can't do it. So it's not advisable ever.
And by the way, real quick, Michael, you know why he's a bond buyer of treasuries? Because he has to. Folks, by their prospectus, a bond guy has to buy bonds. He can't go to cash and sit there in cash. And an equity fund, a stock guy, whether it's aggressive growth, large cap, small cap, whatever, they've got to be fully invested at all times. They can't move to cash even if they think it's dangerous. And so it's your job to know when to sell the fund, not theirs. The portfolio manager you are not his client. The fund is his client. And the fund says, I want to be 100% long, all in, all the time with no breaks. By the way, Michael, before we get to your sector, I did want to bring on Ted. We've got Ted. Do you have any further comments about the market? I should give everybody a chance to chime in.
Yeah, so going off your point about risk management, I actually tagged Don in this tweet, and I think this is a great example of someone not respecting price and just going off their story and their opinions. So he tweeted, "As of today, I am down 2.2 million on my AMC position from its all-time high. I continue to hold because I've done a 5-year fundamental outlook of the company. I do my own research, and I have the conviction and patience to know this will play out in time, just as I think it will." So my whole point here is he talks about him doing his research. He has conviction and patience, but he doesn't realize that his research could be completely wrong. His fundamental outlook might make sense to him, but it does not make sense to the market, which is reflecting in AMC's price. And so AMC is currently at $7 from its 72-ish all-time high. It's had some bear market rallies to 34 and to 28, and it just does not seem like it's going to go anywhere.
And by the way, I'll go you one better, Ted. His research could be spot on, and he could be absolutely right about AMC, but guess what? The whole market takes his stock down. Folks, when the market sells off, 75 to 80% of all stocks go down. So you can have look at the best of the best. Look at the Tesla, look at the Apple, pick a stock. There's only a very, very few that are even, flashing green or showing strength in this past rally. In this past sell-off. If you flip the chart over and put a negative in front of it, it'll be a rally. All right. So, Michael,
Ted, what was my reply, Ted, to your to that text?
Can you say it on the air?
It was a Forrest Gump quote, but I can't find it right now.
Yeah, Mama always said, "Stupid is as stupid does."
That's dumb. Oh, that's stupid.
Actually, he goes on to say, "Smart investors accumulate beaten down stocks, like those whose company's future seems bright." So
seems is the word in there. What
seems
happens?
Bright? Yeah,
right. See, and this is one of O'Neill's classic rules, and it's one of the most important ones. Is the fundamentals will always look good at the top. The fundamentals will still look good 2 quarters after the stock has rolled over and gone down 20, 30, 40%. And then you realize, oh, the fundamentals are deteriorating. And then what do you do?
Yeah, because the price
deteriorate after the price is already down. Then your dream's crushed.
So what Don's
you're happy as long as I don't care that the stock is down. My thesis is still intact. Yippee! And then your thesis goes off the rails after you lost half of your investment or more, and then you're demoralized. Where do you go from there?
Well, price, and that's a great point. Price is a leading indicator. In fact, it's one of the stock market is one of the best leading indicators of the economy. And that's the same thing that it's a macro level. Same thing is true on a micro level with the stock. The price will start selling off before the earnings deteriorate. Don's absolutely right. But even to tag on top of that, the next up cycle, your stock may not be a leader anymore. Its earnings are going to deteriorate. And then as the economy picks up, is it going to be the next leader? Or is there going to be a different sector, a different area, or a better stock, or even a competition in that same sector? You don't know that in advance. People, if you're that clairvoyant, you'd own the small island of Hawaii, right? So that's why you got to follow.
When Nokia phones were the absolute cream of the crop.
Bomb, yeah.
In cell phones.
Well, look at WorldCom in the late 90s. Yeah, WorldCom in the late 90s.
Well, there was fraud involved there with WorldCom, but just took their eye off the ball. Look at Intel. Intel was far and away the chip leader. Now AMD.
They just called that aggressive accounting, Don.
Aggressive accounting.
Yeah.
Not generally.
It was called GAAP. It was called GAAP plus. I couldn't help it. All right, Michael. Let's go to the managed healthcare. What do you got? Sorry.
All right. So this industry is healthcare technology, and there's a few names that are interesting there. 2 of which were recently acquired. So there's a lot of M&A activity. CVS bought Signify, SGFY, and Change Healthcare was acquired by United Health Group. So the first one I want to talk about is EVH, Evolent Health, and basically the thesis behind this healthcare technology sector is there's been an exponential rise, and not just recently, but for a long time, there's been an exponential rise in U.S. healthcare expenditures, and it's been growing faster than GDP growth and population growth. So there's a lot of inefficiencies, and it's unsustainable. The U.S. has the highest healthcare spending per capita, comes out to about $12,350 per person annually, and it accounts to 19.7% of GDP, $4 trillion a year, and it's growing now with an aging population. The U.S. healthcare system is broken and the most inefficient of any developed nation, just in terms of that spending per capita and percentage of GDP. Growth medical care expenses have outpaced inflation since 2000. They're up 110.3% since 2000, while all goods and services are up 71%. The current healthcare model is facility centric, which means going to the hospitals and the medical groups, and there hasn't been a lot of investment in preventative care and home services, which is where these guys come into play. Data collection and analysis is a time-consuming and difficult area of the healthcare industry. So that's where these companies are trying to modernize and revolutionize that. So what Evolent does, ticker EVH, which is the one that's on the screen now, Evolent works as the middleman between payers, which are your insurance companies, Medicare, Medicaid, and the healthcare providers. And they seek, basically, insurance companies, the payers, are seeking the lowest payouts, and providers, which are the hospitals and clinics, seek the highest fees. So Evolent, their mission is to reduce the expenses to payers by turning the focus away from fees for services and reimbursements towards value-based care. And they're both the payers and the providers are both on opposite ends of the spectrum. So costs are growing because they're both fighting in different directions. And Evolent's fastest growing part of their business is the clinical solutions. So what they do is the clinical solutions platform uses data and predictive modeling to identify which patients are likely to be the most expensive. So once they identify those patients, they're able to determine what kinds of interventions can likely bring down the cost of having that patient. For example, instead of waiting until the patient needs remedial care, preventative measures can be taken, such as a phone call with a nurse, home visits. That's why you've seen the rise of teledoc in these services as well. Home visits by a healthcare professional, which ultimately saves the payer money, because instead of waiting until there's a big problem and going to visit that doctor and spending all this money at the facility, they're able to address that problem way earlier on, and it saves both the payer and it also saves the provider's money, because it's a lot less expensive instead of having this huge facility with nurses and doctors and staff. You can just do a telehealth call or have a doctor go and visit that patient. So the bottom line is Evolent aims to address the inefficiencies in the U.S. healthcare industry by aligning the goals of payers and providers. I'll quickly talk, and if you look at the chart here, Evolent's been, if you look at the relative strength of 96, it's been outperforming the market basically since early on this year. It broke out from a long cup and handle. It was riding that 50-day moving average, tried to break out in September, and it just couldn't handle the weight of the overall market, so it pulled back. And now it's today it tagged that 50-day moving average. It's consolidating below. So look for it to reclaim that 50-day moving average, start building higher lows, regain some of the shorter term moving averages. And once the market gets its footing back, then it's possible that this stock could actually break out and do well. And then one thing I want to mention quickly about the earnings estimates. MarketSmith, for the most part, is good on their EPS, but I did notice going through SEC filings and just what the companies reported, they're not profitable at the moment, and for some reason, MarketSmith has them as positive EPS. I called MarketSmith to ask them about that, and they said that a lot of their EPS or all of their EPS estimates are non-GAAP, and they come from this one website, FactSet. And I didn't look at, I mean, the company didn't report non-GAAP profitability, so I'm not sure where exactly they're getting those numbers from. But it is important to, even if the fundamentals look good on MarketSmith and the charts, just double check somewhere else, because they're not always 100% accurate, and there are some discrepancies.
Hey, very quickly, Mike. Mike, before you
Yep.
go to the next stock, I want to make a point that drives home what we're talking about right here. So he's identified a very strong stock. It's got great relative strength, and that's on his watch list, and he's ready so that when the market does finally complete a bottoming process and starts to rally, he's already got a few ideas and a few stocks. But even though he likes that stock, he doesn't own it. We don't own it right now because the market's not acting right. And even with those good, quote, fundamentals, that stock has also gone down, dragged down with the overall market. So that's why it's so important to look at the overall landscape, the market, and then the sector, and then the individual names. You can't just rely on individual names. All right, go ahead, Michael.
Yeah, the fundamentals are what, if I track this story and continue looking at how they're growing and the fundamental analysis, that'll give me the conviction when it is time and the market does turn to initiate a position. And conviction's super important, and the only way to get that is through your analysis. So the second one is Change, ticker CHNG, and Signify, SGFY. They were recently acquired by CVS. They're a value-based healthcare platform as well, and focused on quality of care rather than quantity of patients, and that's what these healthcare service providers are trying to do. Signify focuses on home and community services for in-home evaluations and diagnostic and preventative services. Just like Evolent, they focus on these preventative services. Signify relies heavily on data and algorithms to identify patients and reduce analysis time with increased accuracy. Delivery of care to patients is optimized using this technology. So basically, what these companies do, long story short, is they use AI and algorithms and technology to compile data and provide preventative services and care, so that insurance companies can save money by not having to pay out these heavy bills when there is a serious issue that needs to be addressed. And then the providers and the doctors and medical groups also benefit by not having they can reduce a lot of their overhead expenses by using services like telehealth, and it's just it's better because there's a huge problem with healthcare in this country, and this is one way to address that. So then another one is Change. They were also bought out, so I won't go too much into Change, but it's a similar story. CHNG. The reason why I'm bringing up these companies that were bought out recently is just to show that the sector is interesting. There's a reason why they're being bought out, and it's a rapidly growing, attractive place to be. So another one that's still publicly listed that is investable is Privia, PRVA. And what Privia does that's a little different is that they're a physician organization. So they're actually a company that's run by physicians, and they've created this organization that partners with primary care and select specialist physician practices, health systems, payers, and employers. So they're able to they allow independent providers to practice medicine their way while enjoying the benefits of an integrated medical group. So Privia's top performing providers work together to reduce these utilization costs, improve the patient experience, and advance population health. So it's a similar thing too, but their edge is that they have a group of physicians sort of running the business. So that's but they all rely on these algorithms and data, and it's just different ways of acquiring that data and then acquiring clients and customers to use their platforms. So yeah, and Privia, same thing. It's a great story. This one actually, from the research I've done, is profitable and has been profitable. But the technicals, similar story, broke out in June from this nice cup and handle, was hanging well above that 50-day moving average, but with the weight of the market now is broken below, and could easily pull back to this 200-day. So even if the fundamentals are great, if you're not in tune with the technicals, if you had bought at $44 and it pulls back to 28, you've lost 40% of roughly 40% of your position. So it's always better to wait and get in at the right time. But this is a story that is attractive as well, and could be good once the market recovers and we're in a new bull trend. So one to keep an eye on as well.
All right, Michael, thank you. So I just want to take a quick poll. And obviously you can tell that we're not very professionally polished and groomed. And this is raw data. This is real. This is live. These guys don't know I'm going to ask this. Okay. Quite frankly, I didn't know 15 seconds ago, but I just thought of it.
Everybody hold on.
Just flying by the seat of my pants, baby. just out there.
Right.
So, Michael, how many stocks do you have on your watch? I just need a number on your watch list that are bullish right now. Meaning timely, technically.
I've got a few that I'm watching to see if they hold the 50-day moving average, but above the 21 that I would buy, I only I think I have one actually.
Okay, all right, that's what I want to know. All right, Ted.
Yeah,
Ted, how many stocks do you have that are actionable, meaning buyable right now?
Buyable right now, 0. But
0. That's
I'm seeing
okay.
That BJ. Yeah,
huh?
0.
Okay.
0 or buyable right now.
All right. Well, you could quickly talk about the ones you're bird dogging that you have on your watch list. What are those?
Yeah. So BJ and HLIT Harmonic are actually above all of their key moving averages. So those are some things I'm watching.
That actually looks pretty damn good for the compare relative basis to the market or other stocks. And what was the other one?
HLIT. It's a little thin. It's definitely thin, I think, for Revere.
Well, for Revere, yeah, but the listeners can do it as an individual.
Yeah, exactly.
That actually looks even better. Yeah. Okay. Don?
Yeah. And then I have one more too.
Okay.
If you want an interesting one, WWE, which isn't being super followed at the moment, but that one it's breaking now below the 21, but it's held up pretty well, and could potentially be a buyout candidate because they recently lost their CEO, and there's a lot of speculation around that, and that one's been holding up very well as well.
Okay, so you didn't get the memo, I guess. You don't know that we're not allowed to talk about WWE and World Wrestling on the podcast because Don will light up and start talking. Woo! Actually, quick story.
Yeah.
I was actually at the Texas Tech UT game with my daughter.
Okay.
Watched Texas Tech beat Texas in overtime. What a game.
It's a big deal.
But you know who the MC was? Don's favorite guy.
Nature boy Ric
Flair.
Flair.
Nature
No
boy.
way.
Woo!
Really?
Oh yeah, they kept having him. Yeah, it was.
Oh, yeah.
It was. I felt sorry for him because he was trying to look nice because he's he's the MC, right? And so he's got a bright red jacket on. It was 95 degrees. he was sweating out there. I felt sorry for him. But they also
and profiling.
He was. And they had him on the jumbotron like every time Texas Tech scored, he'd go woo. So I don't know if he's alumni or not, but I got the feeling he might have been. You might want to look that up, Don, so you know your trivia. All right, Don. How many stocks do you have that are actionable and buyable right now on your watch list?
We had one survivor from the 21 over 21 list last week, and it was First Solar. and it's still holding on to the 21-day exponential moving average. Note the stochastics have rolled over, though, and TAN, the ETF that represents the sector, has rolled over also. In fact, it's all the way down to the 200-day moving average. The second leader in solar was Enphase, ENPH, and this has broken the 21. The 21 has rolled over, but it's holding the 50-day moving average. Both of these are leading stocks still as far as a relative strength goes, and if the market rights itself and can put in a bottom, these should be at the top of anybody's leaders list. Ted mentioned already BJ's. That was the second one that I added back to the list because it closed above the 21 yesterday. And the third one I mentioned in the video last night was Las Vegas Sands, which is because the Chinese Communist Party gave the okay for people to start going to Macau to gamble again, and LVS has a huge presence in Macau. So LVS forming a nice flat basis actually looks pretty good. The last 4 days before the gap up didn't look good, but when something like this happens, gap up on big volume, we put it on our list and see how it plays out. But of course, you got to have that giant capital M, which is market, going for you if you're going to be picking any of these stocks. And we certainly don't have that going for us right now.
Well, and that was my point, because in a good, healthy market, when the market is more stable, or more importantly, in an uptrend, because remember, all stocks hate you, okay? I can't stand it when people go, oh, this is a stock you just buy and you put in your drawer.
I know.
You mean like WorldCom, bankrupt?
Yes, of course.
Like Dell got so, remember all the millionaire, they call them the Dellionaires in the 90s, because Dell was one of the best performing stocks. And then with the tech wreck, it got so bad, Michael Dell took it private because it got so ugly and so weak. And then he kind of had to fix the problems and then take it back public again. So you don't want to get married to anything, right? Right. To any stock. It's just a trading chip. So I like stocks when they're going up. I hate them when they're going down. So you just got to take that. You can't get married to any idea. But the point being is, in a healthy market, you are going to have lots of stocks on your watch list. Don, normally in a good market, he does the Friday night big show with the 21 over 21, the 21 leading stocks over the 21 exponential moving average. A lot of times he has more than 21 and he's got to trim that down. He's got to pick the best of the best. Right now, you're lucky if you find one or two good stocks that are timely. So you got to separate the stock from the company. A good, well-run company is fine, but it may be dead money for a couple, 3-4 years. It could lose you money for a long time. It's only when it's going up is it a good stock, right? Point being is, that is a very big measure of risk. When you can't even find enough stocks on one hand. You can't even find 5 that are buyable right now. And that means the market is very, very ugly and it's very dangerous. So remember, the theme of the show is it too late to sell? Because all these articles now are coming out about how to reach out and console your client. We're not having to do that, but yeah, they're like psychology papers for the advisor, talking about how to, make
let them down easy
to stay the course and not leave, because people are leaving their advisors in droves because they told their advisor when they were down 10 or 15%, hey, I'm scared. This doesn't look right. We got a lot of headwinds, and the advisor, just stay the course. Just don't worry about it. And now they're down another 10 or 15%. And so now these people, they're struggling. So in any event, Don, I think we did a pretty good market review. Do you want to go over anything else?
No, we just made fresh lows on the day. So this is fresh lows for this correction also. Yep. So third leg down is underway.
Third leg down is underway. Folks, listen, we did this show early, and it happened to be a blessing, a godsend. So Zach is going to be out of town this Friday. He's going to see some family. So we did this show early today on Thursday. This is our early edition, but it's actually an important update edition to wake people up and say, you need to have a plan. Hope is not a plan. Staying the course while you're your portfolio continues to bleed is not a plan. Well, it's a plan. It's not a good plan. It's a really bad plan, right? So if you're losing the football game 28-0, you might want to change the plan. Different defense, different offense, whatever. Folks, listen. If you need a complimentary portfolio review, or you just want some help, or you got some questions, reach out to us. You can email any of us, Dan@revereasset.com, Don@revereasset.com, or Michael or Ted at revereasset.com. We really made it very, very simple. Okay. You can also call us old school at 855-REAL-WEALTH. Folks, have a great weekend in the next couple days. There's not going to be a show on going out Friday and then Saturday morning. So watch Don's 21 over 21 Friday night. You can go to our revereasset.com website, and in the top right corner, there's a subscribe button. You can tell your friends and family about it. They can just put their name and their email address in there. We won't bug them. We don't spam them. It's up to them to reach out to us if they want any help. Right now, lots of people need help because it's not too late to sell. Folks, we'll talk to you next week on Your Money.
Because it's not how much you make, it's how much you keep.